The real estate and banking world is set for a massive shakeup in 2024. Experts predict a crisis looming on the horizon, with big banks set to bulk up and power players tightening their grip. This roller coaster ride isn't new. It's a historical loop of bank busts and mergers, each sparked by its own unique trigger. This time around, it's the commercial real estate collapse calling the shots. It's the little guys, small banks, who might feel the squeeze hardest. They're dangling on a risky limb with their heavy bets on commercial real estate loans. While regulators and wise minds are sounding the alarm, they're also reassuring us this storm's manageable, not a repeat of the gut-wrenching 2008 meltdown. But the Federal Reserve's lifeline for struggling banks is about to be reeled in. This could cause potential liquidity nightmares for the smaller banks. So what is the smart move? And where do we go from here? In the aftermath of the COVID-19 pandemic, a shift has occurred in how we work and shop. With more professionals opting for remote work setups and consumers flocking to online platforms, traditional brick-and-mortar establishments like malls, department stores, and outlets are feeling the squeeze. As a result, the once bustling commercial spaces now stand empty, with vacancy rates skyrocketing and property prices plummeting. Not even major property investors like Brookfield and Blackstone are immune, as they find themselves reluctantly walking away from their mortgage obligations. This unsettling scenario paints a scary picture for commercial property owners, who may soon find themselves unable to keep up with their loan payments, possibly as soon as next year. And while this spells trouble for businesses of all sizes, it's the small and mid-sized banks that could bear the brunt of the fallout. Commercial real estate lending accounts for a significant chunk, roughly 18%, of the loan portfolios of these smaller banks. A recent report from the National Bureau of Economic Research, or NBER, warns that such a crisis could push approximately 385 U.S. banks, primarily smaller ones, into bankruptcy. A prospect that could cast a dark shadow over the ongoing economic recovery efforts. Meanwhile, the demand for commercial space continues to dwindle, with vacancy rates hitting an amazing 20% in the third quarter. The value of these properties has already taken a nosedive, dropping around 20% from early 2022 to late 2023, with further declines of 5 to 15% expected in 2024. The looming problems of loan defaults is quite large, with NBER estimating that investors could default on anywhere between 10 and 20% of commercial real estate loans. In fact, a report by the Newmark Group suggests that $1.2 trillion in commercial real estate is on shaky ground due to declining property values. In the short term, office space poses the biggest challenge, accounting for over 50% of the $626 billion in debt set to mature by the end of 2025. It's clear that the commercial real estate sector is in for a rocky road ahead. It's been nearly a year since the banking world got rocked by a crisis, leaving 3 U.S. regional lenders in ruins and prompting a swift takeover of Credit Suisse in Europe. Now, a fresh shiver is coursing through banks across the globe, from the bustling streets of New York to the neon-lit avenues of Tokyo and the serene lanes of Zurich. The culprit is mounting losses stemming from loans gone sour in the troubled commercial property sector. Take the recent case of the New York Community Bank Corp., for instance. In a strategic move last year, NYCB emerged victorious in the bidding war for assets linked to Signature Bank, which collapsed shortly after the demise of Silicon Valley Bank. This acquisition propelled NYCB's assets beyond the $100 billion mark. Unfortunately, their shares took a nosedive, plummeting 38% after revealing a staggering $252 million loss for the last quarter. To cushion the blow, the regional lender had to stash away $552 million in the fourth quarter to absorb anticipated loan losses, a stark rise from the $62 million in the previous quarter. What caused this was a loan tied to financing an office building, adding fuel to the fire. The fallout was swift and far-reaching. The KBW Regional Banking Index took a sharp dive, plunging 6% in a single day, the craziest drop since last May, when California-based First Republic met its demise. But it didn't end there. The index continued its downward spin, shedding another 4.8% by mid-morning the following day, dragging NYCB and other regional banks down with it. NYCB's stock bore the brunt, tumbling nearly 13%, while Bank of California and Bank United weren't far behind, each taking an 8% hit. In their earnings statement, NYCB pinned a significant portion of their losses on office buildings, a sentiment echoed by CEO Thomas Cangemi, who highlighted general office weaknesses throughout the country in discussions with investors. Since the upheaval last spring, both investors and regulators have been keeping a vigilant eye out for any signs of renewed strain in the banking sector, particularly focusing on their exposure to the struggling commercial real estate market. With millions of workers sticking to remote work arrangements from the pandemic era, the value of many buildings has taken a nosedive, leaving vast swaths of office space either vacant or severely underutilized. Also, historically high interest rates have made it increasingly challenging for real estate developers, who often rely on hefty loans to fund their projects to meet their repayment obligations. Japan's Aozora Bank found itself caught in the crossfire, attributing a portion of its projected annual loss of $190 million last year to sour loans linked to U.S. office spaces. This dismal forecast was a far cry from its earlier expectations of a net profit of $160 million, causing its shares to plummet by over 21%. The bank painted a sobering picture, suggesting that it could take another year or two for the U.S. office market to find its footing as more workers gradually return to in-person work setups. Additionally, as the Federal Reserve shifts gears from hiking interest rates to cutting them, the landscape could see further adjustments. Europe is feeling the pinch as well. Swiss private bank and wealth manager Julius Baer delivered a sobering blow, revealing that its adjusted profit had plummeted by a staggering 55% last year, primarily due to a colossal loss of $680 million stemming from loans extended to a single European conglomerate. In the wake of these losses, CEO Philipp Rickenbacker announced his departure from the helm of the bank. According to a Reuters report, the spotlight falls on Sigma Group, an Austrian property developer that made waves in 2019 by snagging a piece of New York's iconic Chrysler building. However, the picture isn't all rosy. Several Sigma subsidiaries hit rocky waters and filed for insolvency in December. NYCB revealed that their rough fourth quarter was partially attributed to absorbing a hefty $13 billion in loans from the now-defunct Signature Bank, one of the casualties of last year's banking debacle that saw 3 regional U.S. lenders crumble. These lenders stumbled in the face of skyrocketing interest rates, failing to anticipate and effectively manage the fallout. Anxious depositors, fearing the worst, hastily withdrew their funds, triggering a wave of old-school bank runs. The resulting panic rippled through financial markets, ultimately pushing Credit Suisse, once a titan in the banking world, to the brink, forcing a swift takeover by rival UBS. Other major players are also bracing for potential hits from the commercial real estate realm. Take Germany's juggernaut, Deutsche Bank, for instance. In a move signaling the gravity of the situation, the bank earmarked €123 million in the last quarter to cushion the blow from potential defaults on its U.S. commercial real estate loans. That's a jaw-dropping quadruple leap from the amount set aside during the same period in 2022. The tremors are rippling through the banking world, sending shivers down investors' spines. The KBW Nasdaq Regional Banking Index, a kind of barometer of mid-sized bank stocks, has taken a gut-wrenching plunge of nearly 12% in the past week. The cause? Growing apprehension over lenders' exposure to the precarious commercial real estate loan portfolios. With office occupancy rates plummeting and interest rates soaring, the stage is set for a perfect storm. The seismic shift in working norms post-pandemic has sent shockwaves through the commercial real estate market. Now lenders find themselves staring down the barrel of a looming maturity wall, totaling a staggering $1.5 trillion in commercial real estate loans, slated to mature this year and the next. It's a precarious situation, especially for U.S. regional banks, which shoulder the lion's share of these loans, putting them squarely in the firing line. While officials are quick to acknowledge the risks looming on the horizon, they're keen to downplay fears of an impending crisis. Treasury Secretary Janet Yellen, speaking before the House Financial Services Committee, expressed confidence that the situation is manageable, albeit conceding that certain institutions may find themselves under significant strain. Adding fuel to the fire, a crucial funding lifeline is about to be severed. On March 11th, the Fed's Bank Term Funding Program, the safety net extended to distressed lenders in the wake of Silicon Valley Bank's collapse, will cease offering specially low-interest loans. This program was a beacon of hope for struggling lenders, aiming to bolster their finances at minimal cost and restore public faith in the broader banking system. However, the dwindling share prices suggest that investors remain skeptical of this narrative. And despite looming concerns of a potential wave of bad loans on the horizon, other European banking giants such as Banco Santander and Deutsche Bank opted to ramp up their involvement in the $6 trillion U.S. real estate debt market during the first half of last year. This move, reported by S&P Global, underscores a calculated risk undertaken by these institutions, despite the uncertain landscape ahead. So maybe there just might be some sort of relief coming after all. And that's it for today's video. If you enjoyed it, please remember to watch our other videos on finance, economics, and the world at large. And don't forget to hit that subscribe button. We'll see you in the next video.